In recent months, Bitcoin's decline has caught the attention of even the most experienced investors. After reaching a new all-time high in early October, the asset pulled back about 40%. For an asset often described as digital gold and the future of money, a correction of this magnitude raises an inevitable question: what's really behind this wave of selling? Howdy guys, I'm Chad. I'm the host here at Zero Markets, and today I'm going to break down the factors driving this move with analysis, context, and a strategic perspective. First key point, there is no clear evidence of a structural breakdown in the long-term thesis, okay? The recent correction appears to be the result of a combination of factors, including institutional activity, tighter financial conditions for sure, forced liquidations, and reduction of concentrated positions. In other words, this move is more about market dynamics than a fundamental flaw in the protocol. But that doesn't mean risk has disappeared. Despite the digital gold narrative, Bitcoin still behaves like a high-risk, high-volatility asset, especially during periods when investors prioritize safety and income. One of the main drivers of the decline was the behavior of large institutional investors. You see, in recent years, multi-asset funds, crypto funds, and professional asset managers built meaningful positions. When the macro environment becomes less favorable for risk assets, these participants reduce exposure very quickly. With rates staying higher for longer, alternatives such as cash and government bonds began offering more attractive returns with lower volatility. In defensive environments, volatile assets are typically sold first. Another decisive factor was the unwind of leveraged positions. Investors trading with borrowed capital amplify gains on the way up, but also magnify losses on the way down. As prices fell, several positions were automatically liquidated by brokers and platforms, and that triggered a domino effect. At the same time, discussions around quantum computing intensified. While it does not represent an immediate threat, the debate reinforces an important point. Bitcoin's value depends not only on scarcity, but on continued confidence in its technological security. We also saw the exit of highly concentrated trades. See, many investors were positioned in similar ways. When confidence weakens, simultaneous selling accelerates the decline. Corrections between 30% and 50% are part of Bitcoin's history. We've seen this pattern before, guys. Speculative euphoria, sharp adjustment, and then gradual recovery. The difference now lies in the market structure. Today, Bitcoin is far more institutionalized. It trades alongside other risk assets and responds directly to shifts in risk appetite or risk aversion that also impact equities. Another key point is the growing complexity of the ecosystem. Bitcoin is now traded through futures, through options, and structured products. And this sophistication increases liquidity during bullish phases, but also deepens corrections when positions are unwound. There's also a relevant accounting factor. In the US, rules are moving toward requiring companies to record their crypto assets at fair value. That means price swings directly impact quarterly earnings. Companies with large holdings may see profits pressured if Bitcoin declines near quarter end, even without selling. This can encourage preventative adjustments in corporate portfolios. This episode serves as a test for the narrative. A true hedge asset tends to preserve value when markets are nervous. In practice, Bitcoin declined alongside other risk assets during the recent turbulence. And this suggests that, for now, it behaves more like a speculative asset with a long-term adoption thesis more than a safe haven. Its performance still depends heavily on liquidity, confidence, and institutional flows. So if you get nothing else, get this. The main lesson is not to try to guess the market bottom. It's to define a position size aligned with your risk tolerance. A core and satellite approach can help. The core of a portfolio should consist of diversified structural assets. Bitcoin, if included, tends to work best as a complementary position, not the core. A possible reference: 0% for those who don't believe in the thesis or can't tolerate volatility, 1% to 3% for limited controlled exposure, 3% to 5% for long-term investors with high tolerance for fluctuations. Gradual buying tends to be more prudent than a single entry, and rebalancing prevents the position from growing beyond the intended allocation. So in the end, there are two possible scenarios: more favorable environment with greater liquidity and renewed risk appetite, or higher rates and persistent caution keeping pressure on prices. With proper position sizing, you don't need perfect timing. You need discipline, strategic consistency, and a long-term view. That's how you build authority in volatile markets. All right, if you found this content helpful, like the video, share it with someone who needs to see this, and subscribe to the Zero Markets channel.